Today, financing solar like real estate with Jim Spano, co-founder of RadiantREIT. I'm Tim Montague, your host. Welcome to SolarWorks for Illinois. Mr. Jim Spano is a managing partner of Spano Partner Holdings and leads other ventures as a nationally recognized expert in solar development and finance. He is the co-founder and head of originations at RadiantREIT, which is the first solar mortgage real estate investment trust in the country, established to offer long-term fixed rate debt that enables more self-ownership for developers and healthier balance sheets. Jim is also the co-founder of MyResi, an energy storage development company using aggregated residential solar plus storage to operate as a virtual power plant. Welcome to the show, Jim.
Thank you. Nice to be here.
You and I met a couple of years ago at SPI. I had no idea at the time what a legacy you have already created for yourself in the solar industry, and I'm so grateful for your work both in New Jersey and across the Atlantic coast and nationally. So thank you. You have been very instrumental in growing our industry.
Thank you.
And at the time, you were just rolling out. You were giving your first dog and pony shows about RadiantREIT. So give us the elevator pitch. What is RadiantREIT and why is this so important for our industry?
Sure. RadiantREIT, as you mentioned, is the first solar mortgage REIT in the U.S. Why it's so important to the solar industry is that the solar projects until now have been financed under what are referred to as mini-perm debt, which basically means it's short-term debt intended to more for equipment type programs than long-term asset programs like solar systems. The result of having without being able to match the long-term nature of a solar project with long-term debt is that you have very high amortization payments up front. You're amortizing a asset that's going to last 25 to 35 years in a very short period, in 5, 7, maximum 10 years in typical mini-perm debt. And as a result, it's the equivalent of it's the equivalent for the average person trying to buy a home and going to the bank and the bank saying, I'm going to give you a car loan to finance your home. Obviously, the payments become so high that it becomes unaffordable. Although you could afford the car, you can't afford the payments you could afford the home, you can't afford the payments when they're amortized in such a short period of time so that the monthly payments are so high. Solar systems have struggled. In the past, most of the solar systems were financed with balance sheet financing, meaning that you're using equity because you couldn't access debt markets because of that inverse relationship between the asset life and the term loans. And that was primarily because most financial institutions looked at solar systems as equipment. And reasonably, when you consider that we get an investment tax credit for the solar system, we get a accelerated depreciation on the equipment. And yet, it's really not, it is equipment, but it's a long-term infrastructure asset. So by treating it as a long-term asset and providing debt that matches like a mortgage on a home as opposed to the car loan, that's what we've done to the solar industry. We've enabled more solar to be built by lowering the cost of capital and by enabling the match of the asset life to the term of the debt so that those monthly payments are affordable and the revenue from the solar projects can not only meet the debt payments and the amortization, but also provide residual cash flows to the system owners so that they're getting a return of capital much quicker. So the ability to match that kind of debt to this type of an asset is what's really going to change and has changed the industry already. We've already seen some of our competitors extending the term of their loans to try and match a longer life. Most often we're seeing, like we do, we're offering debt that will match the revenue contract. So if you can provide a 25-year PPA you can amortize that system over the entire 25 years. Now that's becoming less and less common because the terms of PPAs are becoming shorter and shorter across the US. But that's also, in the past, you couldn't finance those shorter terms because you have what's called a merchant tail, where you have uncontracted revenue, either selling into the wholesale market or trying to replace commercial customers with new commercial customers at the end of a specific PPA period. But generally speaking, the ability to provide long-term debt to the industry is what's really changing and enabling far more solar to be built, and to enable more interest from investors when they see a return of capital that much quicker.
Let's give our listeners a concrete example. If you're a solar developer, let's say developing portfolios of big box stores, and you're doing a PPA with the host, how does this play out for a developer who today is going to what market to finance these projects and tomorrow could go to a product like RadiantREIT? Okay.
Let's say yesterday, because today RadiantREIT is out there in the market, but yesterday, what that developer would do is assuming he doesn't have a balance sheet, which 90% of developers, are not large New York exchange companies. They're, private developers and so forth. So most developers don't have those big balance sheets. So what they have to do is they sign up the customers, and then they have to go out and find a equity investor, a balance sheet investor, or a fund or utility that will buy the rights to that project. So they'll go out and get all the approvals, get the contract to what's referred to as NTP, notice to proceed. That means that the project's ready to be built. And at that point, since the developer doesn't have the capital to build it himself, he's got to sell it at NTP to one of these other investors. That's the standard model that 90% of our developers operate under today. Where the paradigm shift occurs is when RadiantREIT provides that capital that enables that developer to take that project from NTP and take it, notice to proceed, and take it through COD, which is your commissioning, your operation date. By doing that, a developer is able to take the project further along the development cycle, capture that much more value, and interestingly, be able to own the project if they choose to. So by eliminating capital constraints, understanding that, as I said initially, yesterday, the problem that we all had is that we don't have the capital to construct the project. And once it's constructed, there's sufficient equity to where we could own it without any further capital contributions. But we don't have that capital to get it constructed. What RadiantREIT is doing is we're coming in and saying, developer, don't sell your project at NTP before you've captured the value that you've created in your development. I mean, that's what we've all had to do. I've sold hundreds of megawatt at NTP, and I've only kept tens of megawatt on my own balance sheet because of the capital constraints. Now I'm coming to folks like me yesterday and saying, hey, I'll provide you, don't sell that project. I'll provide you 100% of the capital you need to build the project. Not only will I give you the capital to build the project, but I'm even going to give you a little extra capital so that you have cash flow so you can manage your business during that construction process so you can capture the whole value. So by way of example, the first thing a developer will do if he wants to own a project or even get it to COD, he's going to have to go to the bank and apply for a loan. Well, it's the first thing the bank says to you. The bank says, hey, we'd love to loan you the money. Got a good project, big box, great offtake, good credit, great. Write us that first check for our legal and our due diligence, and then we'll consider loaning you money. Now, think about that. Typical real estate type approach, but with real estate, we have pretty much assurance that we're going to get that loan approved. Solar system is not quite so clear. There's technology risk, there's regulatory risks, there's risks that banks and financial institutions aren't accustomed to as they are in the real estate industry. So with what occurs is when you take that project and you can capture the value that you've created by getting it to a notice to proceed, by signing up the customer, getting the site control, getting the offtake in place, getting the approvals that are necessary to build the system in a particular town or in a particular county. Once you get that project to NTP, and you could take that out and sell it to a fund, a utility, or an equity partner, at that point, you've created value, and the fund or the utility will pay you for that project. They'll pay you for the rights to build that project. And they'll typically pay you as much as 10% of the value of a project at NTP. That's the value. You've created far more value, but that's the value you're going to get. Now, if you came to RadiantREIT, the first thing we say to you is apply for the loan. We don't need any of your money up front. If we can't give you a loan, we know this business. We know solar systems. If you bring us a project and we make a commitment, we're ready to loan to you, we're not going to ask you for any money up front. What we're going to say to you is, we'll underwrite this and we'll build the cost, those fees, the diligence fees, the legal fees, all those expenses, we still incur them, but we're going to amortize them into your long-term debt so that you're not having to come up with all that capital up front. That's the first capital constraint that prevents a developer from constructing a project, is having the money, getting the money from the bank. If you don't have the money to get the money from the bank, and you can't write those hundreds of thousands of dollars worth of checks up front, they're not going to give you those couple $1 million to build the project. RadiantREIT doesn't do that, so we've eliminated that first capital constraint. The next capital constraint is what the bank or the financial institution yesterday would do is they would come to you and they'd say, hey, you borrowed, we'll loan you 65, 70% of the value of that project. We recognize that $100 of cost for the project, you're going to get $30 back from the ITC, or $26 today, $22 next year. But yesterday you would have got $30 back on that ITC. So we're not going to loan you all of the remaining 70%. We'll loan you maybe 55, 60, 65 maximum percent of the cost of construction. Well, that means you have to come up with the 30 or 35% until the IRS gives you the money back in your ITC. Well, developers don't have that capital either. That's your second capital constraint. We've eliminated it. We're loaning you 100% of the cost to build the project. And we're recognizing that you could sell this project to a third party and maybe you'll make X dollars. We're going to loan you 100% to build the project, and we'll loan you some of that value. We'll loan you half of it, in fact. So let me use an example. If you have a 5 megawatt project, I'm going to keep the numbers real simple. 5 megawatt project, $2 a watt, $10 million project. It's going to cost $8 million to build, and there's about $2 million of value outside the hard cost to build this system. So the developer might have spent $500,000 to develop this project. He now has a $2 million value. The utility or the fund or his equity partner is going to pay him roughly $10 million for this project. It's only going to cost them $8 million to build it. So that developer is going to have a $2 million profit. And he's going to turn over the project with the EPC contract and make $1.5 million profit because he had a $500,000 base. Now, what yesterday would have occurred is you would have went to the bank and you would have said, while I have $2 million of value, I have no capital, I have no cash to put the couple $100,000 to prepay my legal and due diligence, first capital constraint, to put the 30% of 10 million, $3 million in for the construction. I'm sorry, let me correct that. The construction cost was $8 million. The bank will only loan us 65 maximum percent. So we have to put in the other 35% of 8 million. So it's a little under 3 million. Obviously, that's the capital constraint that prevented it. Today, that developer can come to me. Constraint number 1 gone. I'll take your application, no upfront cost. Constraint number 2 gone. I'm going to loan you the whole 8 million, and I'm going to loan you half of that $2 million profit or value, not profit, value, because you had $500,000 cost. You had $1.5 million of profit. But I'm going to loan you half of that $2 million. So I'm going to loan you $9 million. You're going to have $8 million to pay the EPC to build the system, and you're going to have $1 million of cash flow for yourself to operate your business and start developing your next project or two. Now, that enables you to do more projects. That enables me to get more loans, because every time you do a new project, I'm going to loan you 100% of the capital cost and 50% of the net. Now, what makes that big difference is I'm recognizing that you've created, that you have equity. That $2 million, that value you created getting that project to NTP, that $2 million is cash to me. I would, if the utility was going to pay you the 10 million and it only cost you 8 million to build it, it's cash. So we're going to treat it that way. I'm going to loan you 9 million, knowing that by the time you get this project to COD, now watch this, $8 million cost. I'm going to keep numbers simple again and assume 10 milestone payments to get from NTP to COD. That's $800,000 a payment. You give your EPC and notice to proceed. He starts the contract. You have to give him that first $800,000. I'm going to loan you $900,000. So you're going to give the 800 to him, and you have 100 for your operating expenses and new development expenses. Next payment comes in, 800,000 needs to go to the EPC. I'm going to give you 900. Follow that through. When you get to COD, you've got $1 million of cash flow I've given to you. The $900,000, the $9 million loan. Now we're at COD. A project that was worth 10 million at NTP is going to have roughly a 20% increase in value. So it's going to be roughly worth 12 million at NTP, I'm sorry, at COD. Now, you had a $9 million loan. At this point, third capital constraint. Yesterday, you didn't have access to tax equity. Today, with RadiantREIT, we arranged the tax equity. So we're going to bring in roughly 35% of that capital stack as a capital contribution from the tax equity investor. Now your $9 million loan at COD went down to $5.5 million, because I used that $3.5 million to reduce your loan. So your construction loan got converted to term. I went from a $9 million loan to a $5.5 million loan. And think about it, I went from a $9 million loan on a $10 million value to a $5.5 million loan on a $12 million value. So I now have a nice, safe, secured loan. I've eliminated 1, 2, 3 capital constraints to you as a developer. You now own that project in full. Now you have 2 choices. I can sell it or I can keep it. Well, what we did again, yesterday, you would have never got to this point. It would have been gone. You would have made your $1.5 million profit, sold it to the utility, and been off to the racetrack looking for another job to build another project or develop. To me, that's a job. Every time you develop a project, you get paid. You go, you develop your next project, next job. I'm turning into a business. I'm saying to you, look for recurring revenue. So what I'm going to say to you is, when you get that project to COD, you now have a $5.5 million loan with a $12 million asset. You can sell it and make and cash in at that point. So you're going to do the same thing. Our suggestion is maintain ownership. Now you've gotten cash flow, half of the cash flow you would have had you sold it, because you got $1 million in cash flow. Now you have a ton of equity, and all the cash flow, the net cash flow after debt service from the project comes back to you as well. I can demonstrate to you that you get about 10% of the value by selling at NTP. You get about 20% of the value of the project by selling at COD. So you can sell at COD and double your profit. But by keeping the project, you get almost 40% of the value of the project comes in terms of cash flow back to the system owner, developer, constructor, and owner, one party. Now, having the key to making all of that happen is at COD, when I bring that tax equity in and I give you that term loan, I'm going to give you a term loan that's going to match your revenue contract. So if you could bring to me a 25-year PPA, I'm going to give you a 25-year fixed interest and a 25-year amortization schedule. I want you to think about that. What I've just done is I've created very low debt service because I'm amortizing that $10 million over 25 years as opposed to over 10 years. Yesterday, would have had to amortize that over 10 years. That's $1 million a year in just capital pay down. And then think about the first year. You have to pay $1 million of capital pay down, and let's call it a 6% loan. You have another $600,000 in debt. So you need $1.6 million in debt service. Well, project's not going to generate that. Now, today, I've taken that 10 million, amortized it over 25 years. So now you're talking about $40,000 a year. I'm sorry, not 40, $400,000 a year for 25 years to get you 10 million. So instead of having to amortize $1 million, you're only amortizing 400,000. That's $600,000 of cash flow that stays with you, as opposed to having to go pay down that loan. Now, when you amortize over 10 years, yeah, at the end of 10 years, you're going to own it with no debt. And you're going to have lots of cash flow if you can get to that 10th year. The problem is that you can't qualify for loans because the debt service coverage ratio that says I need $1, typically I'm going to need $1.30 to $1.50 of revenue for every dollar of debt service I have to pay. Well, if I have to pay $1 of debt service and pay the amortization, it's almost impossible for the project to generate enough cash flow. But if I could spread that amortization over a longer period of time, not only can the project cover the cash flow, meet the debt service coverage ratio, but it actually has excess cash. It may generate $1.90 to $2 of cash flow for every dollar of debt service. Obviously, if you cut the debt service in half and the revenue stays the same, you're going to have significantly more net revenue coming into your company. That's the recurring revenue that enables you to operate a business on an ongoing basis and get through what we call the roller coaster or solar coaster ride in our industry, because we go through the ups and downs as we develop and sell, markets change. Now we kind of smooth everything out. We have levelized cost of capital for the entire life of the project, cradle-to-grave financing. We know what our cost of capital is. We know what our cost to construct it is. And we also know what our revenue is. So what does this sound like? It sounds like a bond. I know exactly what my net revenue is every single month, with one exception. Performance is my revenue is guaranteed as long as the system generates the power. So now all I have to do is use a P99 calculation, which tells me that I have a 99% chance of this system generating that much power, and I've effectively provided a bond-like instrument that I can now go to the bank and borrow against. So if you take a step backwards and remember that I said you had $5.5 million loan and a $12 million value, there's a significant amount of equity that a bank will look at. They'll see the positive cash flow, and you'll be able to actually leverage beyond our project finance level. And at a corporate level, you'll be able to get financing. That'll enable you to have access to more capital than you've ever imagined. So we went from a capital constraint to a capital rich position, complete opposite of yesterday to today. And that's pretty much what RadiantREIT is doing. Obviously, there's a lot more detail that I could go into, but I want to give you that quick overview. Wanted to give you a quicker overview, but in order to really answer the question and address the subject. I felt that
The
was
long and
necessary.
short of it seems, the long and short of it to me is that developers can get more projects through the pipeline in parallel than they would have been able to do before they had this tool. Is that not true?
That is 100% true. By providing that extra capital, they're not restrained from new development activities because of the lack of capital tied up in their prior projects. By getting it to NTP and being able to cash out and have that cash flow, it enables them to continue to develop new projects. And more importantly, it enables them to get through a COVID-19 shutdown. Think about that. Developers during COVID-19 couldn't have any development activity. That means that they're not, that's 3 months, if 3 months that they went with revenue deferred by 3 months, while they couldn't build their systems and couldn't get paid from their sales and so forth. By having a recurring revenue stream and owning projects, I've been getting revenue into my company every single month during COVID. Our payroll's never been stressed. We have sufficient capital. That's the key, is you want to operate a business versus having a job. In the old days, a developer had a job. Today, a developer can actually be a business and have a strong ability to have cash flows and have equity that they can sell at some point in the future when they sell their business. And
you're no stranger to economic downturns, and I know that you really dove headlong into solar back in the 2008 financial crisis. What are the parallels between this financial downturn and the previous?
Yeah, there's some parallels, but there's also some significant differences. The last downturn occurred behind a weak economy. This downturn occurred behind a very, very strong economy. In the last downturn, we had to repurpose. We were real estate developers. We had real estate projects and land developers. So obviously, when the real estate markets crashed, the part of the sector that got hit the worst is the development activities. People could buy existing buildings for less than an approved lot that I got approved to sell as a development lot. As a result, the downturn in the 2008 timeframe put a lot of people out of business. It created a tremendous amount of stress to any real estate related activity. I actually survived the last downturn by going into solar. Solar was the magic bullet that enabled me to repurpose a lot of my development projects from malls and industrial centers and strip centers into solar fields. Today, the downturn, I don't think is in our industry. It's not creating a significant change or repurposing need. I think the current downturn is creating a tremendous opportunity. When there's significant change in human behavior, that affects economics. People's behavior determines where the economy and what sectors of the economy are going to be affected. I think this downturn has demonstrated that the need for real estate, the perceived need for real estate and for office space in particular, but also retail, restaurant, across the industry. I think the real estate industry is going to take a huge hit. And I think that the energy industry is going to help the real estate industry get through this crisis. The opposite of what happened last time. Last time, the opportunity was just emerging to convert real estate to renewables. It was a brand new industry. There's a lot more risk. Today, the opportunity is incredible for our industry. I have companies that are offering prepaid leases to a lot of these real estate owners. Why? Well, if your tenants aren't paying you rent, or if you're a mall owner and your rents are based on sales, percentage of sales. So much real estate is based on the foot traffic in and out of the real estate. Well, when we shut down and when we change our behaviors and we have social distancing and we can't fit as many people in small spaces and we have to limit how far people can be apart, which means for example, when you look at a retail store, our per square foot value of how much goods and items and people we can fit per square foot has been dramatically changed. So you're going to see real estate values. You're going to see real estate that is going to suffer in the short term until they readjust to this new way of operating a business with social distancing, which is going to be here for a while, perhaps permanently. The solar industry, the renewables industry, has an opportunity to provide some liquidity into the real estate industry through energy savings. And I think that there's an opportunity for a lot of our solar developers to go out there to the big box that you mentioned earlier. They did pretty well during the downturn. Why? Because the small businesses was closed and they got all the business, and the online businesses did fantastic. So you can see that unlike the last downturn, this downturn is offering all kinds of opportunities. Now, there's a lot of industries that are going to get hurt. There's a lot of industries that are benefiting. The travel industry got hurt. The luxury hotel industry is getting hurt. Even the business hotel industry is getting hurt. Business travel industry. So there's a lot of sectors of our economy that are going to get hurt. But then there's the sectors that are going to do fantastic. You look at Zoom, look at the technology companies, you look at the companies that benefit from social distancing, communications. I mean, there's so many opportunities now. And then construction, converting all of these facilities to this new social distance setups. I mean, so there's going to be sectors in the economy that do fantastic. And now it's really just a matter of, unlike the last downturn, which presented few opportunities and it was a much bigger struggle, I think this downturn is actually, because of its cause and because of the strong economy that it came off of, I think there's a tremendous amount of opportunity, particularly in our industry.
Tell me about how you see DG, let's say commercial industrial, and small utility scale like community solar compared to utility scale, and where does Radiant play? What is an ideal customer for you?
Radiant's ideal customer is any and all that have good offtake and that have solid economics and proper technologies. We're agnostic to sectors within the industry. We're loaning against revenue and certainty. I think the area where we're going to be, two areas we're going to be most focused on is going to be the community solar and the C&I, the commercial and industrial space. And the reason for that is the large utility developers, they have access to capital. If they have a $100 million project or a $200 million project, they have access to capital that it will be competitive. It's the guys that are doing the $50 million, the $20 million, the $10 million, the $2 million projects. Those are the guys that don't have that access. That's the community that we're serving. And we're enabling that small and mid-sized developer to compete with those large developers that have that access. We're basically leveling that playing field. Now that small developer, the paradigm today, I should say yesterday, was that the small developer would develop a project, oftentimes sell it to the larger developer who will actually build it out and own it. Now that small developer has the opportunity to build it out and own it, or at a minimum, build it out and sell it at COD, where they capture twice the value that they would have captured if they sold it at NTP. Understanding that going from NTP to COD is a months period. It may take years to develop and then months to build. And you make just as much value building it as you did developing it. So if that developer can get and take the project past NTP to COD, even if he transacts a sale at that point, maybe he doesn't want to be a long-term owner for whatever reason. At least at that point, he's capturing twice the fees that he would have earned had he sold it at NTP, and his risk is de minimis. You're talking about a couple of month period to construct, and you're talking about a construction process that could be off 2-3% if it's managed properly. You know, these systems are built within, you know, a couple of percentage points of their budgets. So, which is one of the reasons that we're able to loan 100% of the cost of these projects. Obviously, we oversee the construction to make sure that our money is being spent properly and that all of the milestones are being hit. And the construction process is really de minimis from a risk perspective, yet it's treated by the financial institutions as if it's a traditional real estate risk, and it's not. So a developer being able to capture that extra share of the value stream makes a huge difference to the developer, because you're basically overpaying the construction company or the construction funder. You're overpaying them for the project. You're selling to them too cheaply because they happen to be able to have the capital to get it through construction and de-risk it. And it's a minimal de-risk, but it's viewed as much higher risk than it in reality that it is.
Yeah, it gives the developer much more leverage, it seems. So you mentioned that your audience is smaller developers. What differentiates good from great developers?
Interesting question. Good developers have a better understanding of the market that they're working in. That's one of the key considerations. They understand the policy and the state and the utility and the ISO that they're working within. Therefore, they can predict the obstacles and the blockages that could occur that would slow down and make a project more expensive to develop or to build. Good developers understand that when you develop a project, one of the key considerations is the ability to finance the project. I can't tell you how many times developers bring me projects that are supposedly at NTP, and then you start reviewing the leases or the PPAs, and there's provisions in there that you just can't finance. I'll give you a perfect example. Not uncommon to find a PPA that says after the 5th year, when the clawback for the ITC is over, that a host could purchase the system at fair market value. Mm-hmm. Well, it's not financeable. I have to have at least a provision within the PPA that says, look, if you're going to sell it at fair market value, you own it, that's fine. But I need to make sure that my loan's going to get paid off. So if you're going to sell it, it has to be at the higher of fair market value or the loan balance. But I'm not going to finance a PPA that after 5 years, the host can buy the system and there's not enough money to pay off my loan. So, you know, there's little things like that that are within PPAs and within leases that people don't realize. You know, when they are a developer and they're not a financier, they don't realize they got to develop the project in a manner that's financeable in order to capture that value. Now, a lot of times I have to go back and renegotiate that PPA. Well, there's an expense to that. So I'm going to discount the value of that, assuming that I'm not going to be able to negotiate it. Once I've taken ownership and I now sign the MIPA and I now own the project, I'm going to go back to that PPA guy and try and renegotiate that. As a lender, I'm just going to have to walk away. I can't lend to a company whose PPA, whose revenue contract says that the project can be sold and not necessarily guarantee that my loan is going to get paid off.
So are you providing developers, though, some of this legal infrastructure then?
We help developers to develop their projects in a financeable manner. And that I've been doing outside of RadiantREIT for many, many years. It's not been uncommon for me to work with these same developers in the past, have them bring their projects to me that they couldn't get financed and they couldn't sell, and they were, you know, stuck at some stage of development. And then, you know, my other company, my Spano partners, my primary development company, would come in and assist them in cleaning up all the problems that prevented it from being financeable. and getting it out to the market and getting it sold. We have like 42 aggregators that will buy solar projects from developers. That means that you're going to get much better pricing, and that's what Spano Partners does. Is it self-develops, and then it works with developers to help them get better pricing on their projects, because obviously we know the market and we know all the players, and we know which players have a sweet spot for which type of projects, and will value it higher.
So solar is real estate is born. The RadiantREIT is a real product now in the market. How is that going? What has the acceptance been?
It's been going amazingly well. Obviously, we're changing the paradigm on how developers develop and transact their projects. And it's been received. I can't name a single developer that I've met with that has not only shown an interest, but actually applied for either a actual loan or applied for a project that they're looking to develop and want to make sure that it's financeable and that the economics work. I think we've taken in expressions of interest for over $4 billion worth of solar projects. Now, obviously, some of those get built before we can't approve financing. But for the most part, there's a tremendous, an incredible demand for the product. If you look at our only competitor, Hannon Armstrong, super successful company. They're doing fantastic. They have a great product, a great management company that, they're the only player in the market. We came in, we approached the market a little differently, and I think that we have a better product. In fact, I'm sure we have a better product. And I think that we're the reason for our success is primarily because the product that we designed was designed by a developer for developers. So we understood the market, we understood what the challenges were, and we designed the product around it. And the difficulty was getting the investors to put the money up under our new program. That's the real challenge is. And what we found is the investors that are buying these projects, they're recognizing that their margins are getting squeezed as more capital comes into this market. I mentioned a little earlier, we have 42 buyers. That means there's a lot of competition and a lot of offers going in for every one of these projects, which means the margins get tighter and tighter and tighter. The more demand for a project, with a limited supply and a greater demand, what's the result? The result is going to be that demand is going to pay more for the limited supply. So as those margins get squeezed, those same investors are looking at RadiantREIT and saying, well, wait a minute. If we can invest in RadiantREIT and we're investing in debt and get similar returns to what we would have gotten had we invested in the actual projects, which is the case, we're very interested. So we have no concerns about being able to meet the capital needs of the industry. Obviously, there was a process that you have to go through, just by way of background. In order to raise capital, you have to have your product go through a diligence that's an incredible diligence. Obviously, when you're lending over 100% of the cost to construct a project, people question it. They have to understand it. And there's an education process that goes through to help them understand the value of NTP that a developer creates to get a project to NTP. So having looking at margins that are getting squeezed in the ownership model and being able to invest in the debt model and get similar returns with a significantly reduced risk deviated basis, there is a tremendous amount of interest in our product, both from the developer's perspective and the origination side, which I'm responsible for, as well as on the capital raise side, which like anybody else, the hard part of any new venture is getting the initial capital in. Once you get the first round in, the A round, the round B, particularly when you're as successful as us, round B is easier than round C, which is really ultimately what we'll be doing is taking Radiant REIT Public, and that'll be our third round funding, where we go out to public markets and we enable the average citizen, average person, to be able to invest in renewables, which they can't do today, and invest in a tax preferred basis under the REIT structure. Understanding that REIT structure gives us a very low cost of capital because our investors are getting tax-free returns. So their return expectation is lower, and that gives us the margin to go out to the market and loan very competitively, and still make that net interest margin that keeps our company whole and that we operate under to manage the business.
Jim, we're almost out of time, but I wanted to talk a little bit about the role of government. You come from New Jersey, which I like to say is a good 10 years ahead of the Illinois and other Midwest markets. You've seen that market go from 0 to 60. Give us some context and try to answer that question, though. What is the role of government in making the clean energy transition?
Hi. Role of government is absolutely necessary. Understanding that electricity is a utility sale. It's a necessity. No different than our public roads, our infrastructure, our electrical infrastructure is a public good. Having the ability for the government to make policy that will promote good economic value to investors to invest in a long-term savings program. Understand this. If you have an old refrigerator, it's 20 years old, and it eats up electricity like crazy, and then you could buy a new refrigerator that's going to save you a fortune in electricity, but you don't have the capital to buy a new refrigerator. So what happens is everybody suffers because you have this inefficient refrigerator. The average cost of electricity is averaged, not so. If the people that have really bad refrigerators that operate very inefficiently, the cost to maintain the infrastructure is the same. So what we look at is, with good policy, we can drive strong economics. We can get more built for less money. And that's why one of my preaches to the entire industry, every developer I speak to, I said, the one thing that you have to do, get involved in your associations. I'm on the board of the Mid-Atlantic Solar and Storage Industry Association. I'm on the board of the New Jersey Solar Grid Supply Association, the International Battery and Energy Storage Association. It's important that you get involved in associations and participate, not just become a member and write a check, but participate. It's important that you assist those organizations in reaching out to the policymakers. By way of example, we had in New York, we had a VETR program that was set up, and roughly 3 years ago, the balance between NEM, net energy metering, and VETR, the value of energy distributed resources, there are two calculations that were supposed to account for decreases in PV costs and increases in electricity, cost of electricity. So it was kind of to balance to make sure that the subsidy represented just enough that is needed in order to make the economics work for it. And what happened is it came out of balance. The model that was used, the predictive model, was off. So suddenly nobody could get their community solar project financed. I was able to take one of the larger community solar developers in New York that had over 100 megawatts worth of community solar developed, but couldn't get it financed. I was able to then bring him into a chair of the Energy Commission in New York, who's a friend and a colleague of mine, explained to him what the problem was. Obviously, his role as the commissioner of the chair, as the chair of the Energy Commission, his role is to ensure that the policies and regulations are promoting the goals of the clean energy. So by bringing the developers in that were unable to get their projects financed and helping the commission understand what needs to be adjusted to make them financeable so that we can achieve the goals that were set by the commission. We bring the developers in, we meet with the policymakers, we educate them, they understand it, they make the policy. We got not only those projects financed, but there's been hundreds and hundreds of megawatts worth of solar finance in New York now because of those changes that we need in order to balance out that revenue so that you have a financeable project. Understanding that VETR is not a fixed rate; it's a quasi merchant rate. So it's really important that you have a good balance so that there's at least enough contracted rate for a lender to lend against. In New Jersey, same situation. We had several times we've had major crashes in our industry as we have very poor behavior from the solar industry. If we have an RPS cap, we just keep building. Because the caps are continuously being raised, there's this false sense of, well, if we overbuild, they'll just raise the cap. And that's pretty much what had been happening. And as a result, there was emergency bills that went through the legislature and the BPU in order to achieve the goals at the lowest possible price. And I think BPU's done a great job at accomplishing that. I think the legislature's done a great job at developing the policy that was necessary. And I think that it's an ongoing process. We're going to continue. In New Jersey right now, we're preparing our successor program. We're right now in the transition. We closed out the SREC program. We're in the TREC, or the Transition Incentive Program. And we're headed towards our successor program that the BPU will be putting out. These policies and these changes are necessary in order to continually adjust to make sure that we can get as many renewables, reduce the carbon in the atmosphere, and do it at least cost to the ratepayer.
I love your message about joining and getting involved with trade associations. I say that often on the show here. In Illinois, we have an association called the Illinois Solar Energy Association. So to all our listeners out there, wherever you are, get involved in your state organization. It's not enough to be a successful entrepreneur. You have to grow the playing field. Well, thank you, Jim Spano. Really appreciate your time. There you have it, Financing Solar Like Real Estate with Jim Spano, co-founder of RadiantREIT. I'm Tim Montague, your host. Thank you for listening to SolarWorks for Illinois. Please check out our channel on YouTube, subscribe, give us a thumbs up. You can find all of our recordings also on our website, cesnrg.com. Thanks and have a great day.